often meet with a new retiree or someone thinking about retirement who's questioning some of the ideas that they have about financial planning. They've done many of the right things, saved diligently, made careful decisions, but along the way, they picked up some retirement beliefs that are outdated, oversimplified, or just don't really pertain to them. And unfortunately, these myths don't show up as problems right away. They often sneak up well into retirement when it's much harder to course correct. Beliefs like your taxes will be lower in retirement, the 4% rule always works, and RRSPs are always the best place to save. They sound logical, but the retirement world is dynamic. And if your plan is still operating on advice from 20 or 30 years ago, it could quietly be costing you tens of thousands in tax, income, or missed opportunities. In this video, I'm going to walk you through 6 retirement myths that retirees often realize too late and show you what to do instead while there's still time to adjust. Hi, I'm Stefano Francesca, certified financial planner professional and Next Step Wealth Manager with IPC Securities Corporation. If you find this helpful, don't forget to like, comment, and subscribe. It really helps more Canadians see this. Let's get into it. First myth, retirement only lasts 10 to 15 years. This is one of the biggest myths I still see today, and it's one of the most dangerous. For a long time, the common belief was that time in retirement would last significantly less than time in the workforce. And that was actually true back in the 1960s. When the Canada Pension Plan was introduced in 1966, the average life expectancy for a Canadian was around 72 years old. Retirement started at 65, and on average, you'd spend only 7 years drawing from your savings. But today, that timeline is way off. According to the latest Statistics Canada data in 2023, life expectancy continues to rise, and planning to age 95 or beyond is increasingly common for healthy retirees. In fact, Statistics Canada estimates that a 65-year-old Canadian male today has a 50% chance of living past age 86, and a female past age 89. That's not a short retirement. That's nearly 30 years of income, which needs to be supported. Why this changes everything? This shift in longevity completely changes the math on retirement. Longevity risk and the risks associated with providing income over a long period of time are more and more prominent. Because when you stretch your retirement timeline from 10 or 15 years to 25 or 30 years, it increases the risk of outliving your money, the impact of inflation on your spending power, and the importance of staying invested appropriately. A short retirement means you might be able to lean more heavily on GICs or low-growth investments. But a long retirement, that requires a mix of growth, income, and flexibility, or you risk running out of money too early. I've worked with a couple who retired in their early 60s, and they're still going strong into their late 80s. That's almost a 30-year stretch of withdrawals, investment management, tax planning, and healthcare funding. Moving forward, it wouldn't surprise me if we see many cases where retirement is just as long as time spent working. So if your plan is still based on the idea that retirement is just 10 or 15 years, or that you're not going to make it into your 80s, you could be underestimating your needs, making inappropriate investment choices, not withdrawing at a sustainable pace, and possibly underutilizing your CPP and OAS. In the next section, we'll look at another outdated belief, the idea that you should stop working completely at age 65, and why more Canadians are embracing flexible or phased retirement. Second myth, work stops at age 65. For decades, 65 was the magic number, and 55 was the holy grail of early retirement. You hit retirement age, threw the farewell party, and never worked another day. But that version of retirement, it's no longer the norm, and just an outdated concept. Today, more and more Canadians are choosing to keep working in some capacity well into their 60s, and sometimes their 70s. Not because they have to, but in many cases because they want to. The new retirement reality is flexibility. Retirement today doesn't always mean a hard stop. For many, it's a gradual shift from full-time to part-time, from high stress to low pressure, from career-driven to purpose-driven. Some people consult, some start small businesses, others take seasonal work or passion projects that they never had time for. For many, it's not about the extra income. It's about meaning, structure, or social connection. In some cases, even working just 1 or 2 days a week can take a significant pressure off your portfolio, especially in the early years of retirement. Why this matters financially? From a planning perspective, even modest income in your early 60s can make a big difference. Let's say you're earning just $20,000 a year from part-time work between age 60 and 65. That's 5 fewer years of full portfolio withdrawals, or conversely, an early opportunity to leak income at a low tax bracket. It may allow you to delay CPP or OAS, which boosts those benefits permanently, providing longevity insurance. And it can buy time for your investments to grow further. This kind of phased retirement strategy can help smooth out your tax bill, reducing sequence of returns risk, and keep you mentally and emotionally engaged all at once. The bottom line, you don't have to stop working completely at 65. In fact, many of today's most successful retirees don't. Instead of thinking of retirement as a cliff you jump off of, think of it as a ramp you gradually ease down. That flexibility gives you options. And that's one of the most powerful tools you can have in retirement. In the next part, we'll explore a third outdated belief, the idea that RSPs are always the best place to save, and why that strategy can backfire if you're not careful. Myth number 3, RSPs are always the best place to save. For most Canadians, RSPs are the first place we think of when saving for retirement, and for good reason. You get a tax deduction when you contribute, your investments grow tax deferred, and when you retire, you can convert the account into a RIF and draw income as needed. So what's the problem? The problem is when your RSP becomes really large and you don't have a plan to manage the tax bill. RSPs, great on the way in, but not without risks on the way out. RSPs are fantastic during your working years, especially when you're in a high tax bracket and getting big tax savings. But in retirement, because you've never been taxed on that amount you saved or on the growth, it's taxable to you. And if you've spent decades maxing out your RSP without diversifying your other income sources, you might end up pushed into a higher tax bracket in retirement. You could be triggering OAS clawbacks. As well, you could be exposing your estate to a significant tax bill, leaving less to your heirs than expected. I've seen couples in their 70s who are forced to withdraw more income than they actually need just to meet the RIF minimum. This forced withdrawal is really forced taxation. Without a sound withdrawal plan, which takes time to implement, you may be giving CRA more than you need to. A solution? Tax diversification. Instead of putting every retirement dollar into your RSP, consider a more balanced mix. RSPs for high income years and tax deferred growth. Take those tax savings and put them into a TFSA for flexible, tax-free withdrawals in retirement. Use non-registered accounts for capital gains and dividend income, which are taxed more favorably than RIF or interest income. This diversified income approach gives you more control over how much taxable income you show in retirement. You can draw just enough from your RIF to stay in a comfortable bracket for your lifestyle, top up from your TFSA, and manage non-registered withdrawals strategically when you need to. Remember, it's not just what you save, it's where you save it. Your overall retirement outcome isn't just based on how much you've saved, it's based on how much you get to keep after tax. So don't rely solely on RSPs as your retirement saving strategy. Mix it up and build flexibility into your plan. Myth number 4, I need risk-free investments in retirement. I hear this lots from Canadians approaching retirement. I don't want to take any risks. I just want safe, guaranteed investments. And I get it. After decades of saving and working hard, the last thing you want is to take unnecessary risks when you're no longer earning a regular paycheck. The reality is, however, that there is no such thing as a completely risk-free investment. Every financial choice comes with trade-offs. And the moment we try to eliminate one kind of risk, we often expose ourselves to another. Many people equate the word risk with downside volatility or the potential to lose your capital. That type of risk is obvious. It's the less obvious risks that can really hurt your financial well-being. Inflation risk. Let's say you keep your money in cash or GICs because you don't want volatility. Well, if you're not making at least more than the rate of inflation, then you're losing purchasing power every year. That means the money feels safe, but it's slowly losing value. Longevity risk. What if you live longer than expected? If you play things too safe and your investments grow too slowly, you run the risk of outliving your savings. This is a major concern today, especially for healthy retirees in their 60s who may need to fund 30+ years of expenses. Liquidity risk. Some people are drawn to private real estate or other alternative investments that promise stability. But if those assets are not liquid and are hard to access when you need cash, you may be forced to sell something at the wrong time or pay tax unnecessarily. Market risk. Investing in the stock market comes with ups and downs, that's obvious. But avoiding the market altogether might mean missing out on the growth you actually need to fund your lifestyle long term. So ironically, trying to eliminate market risk can create shortfall risk, the risk that your portfolio simply won't keep up. Tax risk. Sometimes the safest looking investments from a return standpoint is the least efficient one from a tax standpoint. If you rely entirely on interest income or draw from RSPs too heavily in a short window, you may end up in a higher marginal tax bracket or even trigger an OAS clawback. Reinvestment risk. Even GICs and term deposits carry risk, specifically reinvestment risk. You might lock in a decent rate today, but what happens when that term ends and interest rates have fallen? Now you're forced to accept a lower return, which can impact your income plan. So what's the answer? The key is to stop looking for one single safe place to put your money and instead focus on building a resilient, diversified income plan that accounts for these different types of risks. That means matching your investments to your retirement timeline, structuring withdrawals in a tax-smart way, keeping enough cash for short-term needs, but not too much that you'll fall behind, and staying flexible because the landscape, interest rates, inflation, markets will change. Your retirement plan isn't about avoiding risk completely. It's about knowing which risks you're taking, which ones you can manage, and which ones you can prepare for. In the next section, we'll tackle another common belief, the idea that withdrawing 4% a year will guarantee your income for life, and why that rule of thumb might not hold up anymore. Myth 5, the 4% rule is set in stone. The 4% rule rule is one of the most commonly quoted guidelines in retirement planning. It says you can safely withdraw 4% of your portfolio each year in retirement, adjusted for inflation, and your money should last for 30 years. It's simple, easy to remember, and widely used. But is it realistic? The 4% rule was created in the 1990s based on data from the US economy during a very different economic environment. And while it could be a helpful starting point, it's no substitute for a full financial plan. Why it might not work today. There have been a few studies done to support, alter, or discredit this rule. Some interesting stuff for a geek like me. These studies bring to light a few things in the rule that don't always hold up. It assumes consistent long-term market returns and historical average for asset classes such as bonds that may not come to fruition. It assumes stable inflation and a 30-year retirement timeframe. But today, retirees are facing longer lifespans and earlier retirement, which means withdrawals might need to last longer than 30 years. Higher inflation volatility, which eats into your purchasing power, and greater market uncertainty, especially early in retirement. If you're exposed to sequence of returns risk, a topic from one of my previous videos, and you keep withdrawing at a fixed 4%, you could run out of money sooner than you expect. Many Canadian advisors today prefer a dynamic withdrawal approach, adjusting income based on market performance and tax considerations. So what's a better approach? Think of the 4% rule as a guideline, not a hard rule. Instead of sticking to a fixed withdrawal rate, consider adjusting your withdrawals each year based on market performance, setting up a cash wedge or income reserve to avoid selling investments in a down market, using multiple income streams like CPP, OAS, TFSAs, and non-registered accounts to give you more control. Don't rely on guidelines. Have a well-thought-out plan in place and revisit that plan regularly. The best plans aren't rigid. They're flexible, responsive, and built around your real-life spending needs. In the final part of this video, we'll look at the last and maybe the most important myth. Myth 6, retirement is just about the money. This might be the most common and most misleading belief out there. A lot of retirement planning focuses on the numbers, how much you've saved, what your investments are earning, how long your money will last. And don't get me wrong, as a financial planner, I love crunching numbers and making plans. But here's what I learned after working with hundreds of Canadians in or nearing retirement. The best retirements aren't just about the size of your portfolio. They're about how you spend your time and who you spend it with. Retirement isn't a finish line. It's a new chapter. I've seen retirees with multi-million-dollar portfolios feel lost, bored, or disconnected within a year of retiring. And I've seen others with more modest savings thrive because they had a sense of purpose, a strong social circle, a plan for how they wanted to use their time. Retirement today isn't just about financial independence. It's about lifestyle independence. I've had clients thrive not because they saved the most, but because they had a plan for their time. Whether it's volunteering, coaching, mentoring, or travel, purpose often matters more than net worth. You need a plan for your time, not just your money. What can you do now? When you're building your retirement plan, ask yourself, what do I want my typical day to look like? What will keep me active, engaged, and mentally sharp? What will give me meaning beyond just looking at my portfolio statements? Because the truth is, you can have a great financial plan on paper and still feel unfulfilled if you haven't thought about what you're retiring to. So the most successful retirees I work with, they plan not just their cash flow, but also their calendar. So what's the big takeaway here? Retirement has changed. And if your plan is still based on old rules or outdated assumptions, it might be doing more harm than good. We've talked about 6 common beliefs that Canadians often discover too late and how to overcome those limiting thoughts. 1, retirement lasts longer than most people expect, sometimes 30 years or more. 2, you don't have to stop working completely at 65. Phased retirement has significant benefits. 3, RRSPs are a great place to save, but it's best to diversify income streams and have a well-thought-out withdrawal plan in place. 4, there are no risk-free investments. Be sure to balance both your short-term and long-term objectives with the appropriate mix of investment options. 5, the 4% rule is more of a guideline. Develop a strong, well-thought-out plan instead of using guidelines or rules of thumb. And 6, most importantly, retirement isn't just about the money. It's about what you do with your time and who you spend it with. If you're approaching retirement or already in it, this is the time to challenge those old assumptions and build a plan that reflects how retirement really works today. Here's what to do next. If you're a Canadian retiree or you're within 15 years of retirement and you're asking, is my plan still realistic and based on how things work today? Am I making any of these common retirement mistakes without realizing it? What's the best way to align my savings, income, and lifestyle for the next 20 to 30 years? Then now's the time to take a closer look. Click the link in the description to book a consultation with our team. We'll walk through your situation, test your plan against today's realities, and give you clear, personalized advice so you can retire with confidence. Don't wait, take the next step.